If you're just owning an S&P index fund, okay, you did fine in 2023, and the mega cap outperformance ex Tesla so far in 2024, you're doing fine as well. But if you are not utilizing that strategy, so for the formation, the composition of year-to-date performance is troubling. If you look at the S&P 500, more than half the S&P 500 has negative year-to-date performance. Tesla is down 28% year-to-date. That's the worst performing stock. But there's only about 150 names in the S&P 500 that are actually outperforming the index overall. And then you turn and you look at the S&P Equal Weight, which is down nearly 1% today. And I don't even want to talk about small caps. I mean, small caps, it's absolutely abysmal.
Russell's getting run over.
Down 5% again. What's the message in that?
Down, down substantially. You know, Amy, the mega cap year-to-date performance is already off the chart.
Yep.
Growth versus value is not even close at this point. Growth year-to-date's up 6.5%. S&P value's up 1%. Is this how it's just going to be? Here we go again. Where's the broadening?
It's not happening. It could be where we're going to be for a little while. This is a story-driven market. This is an AI story-driven market. When I heard Caterpillar this morning talking about their earnings and mentioning AI and data center bills being the strongest demand, when Caterpillar is starting to talk about AI, you know this is a story-driven market, and it can't be disproven at least for a few quarters.
I thought the story-driven market, though, included the soft landings part of the story. Therefore, you're going to get the broadening. Where is it?
Right. I think this is now an AI-driven story market. I do think the soft landing story is still part of it. And the economic data is coming in better than expected. Now people are going to start to worry about we're not going to get the rate cuts. But this is a continuation of last year. I mean, last year at this time, we were talking about higher for longer rates. And, you know, you had, again, the January pop in the employment report, and that set up for a great 2023. I do think the difference for 2024 is now you have tough compares. In 2023, you had really easy compares for the mega cap companies because 2022 was an abysmal year. Now you're comparing against much harder numbers and going into 2024. So I do think the setup is harder, but we're trying to disprove something that we're not going to be able to disprove for a little while.
Sarat, Joe points out what Ed Yardeni's talking about, how the Mag 7's, once again, in Ed's words, sucking all the air out of the universe. And by the way, he suggests that it's rational exuberance, what's happening, because that's where the action is both on, and I'll give you more details in a minute on this, but where sort of quality earnings are and sales growth, that's where it is, where the money is.
And to Amy's point, right now you can't fight the tape, and that's where the tape is going. And the other thing that's happening is that, like you said, you know, everything's getting sucked out. Well, people are also keeping money in cash because, as the Fed said, we're not going to cut rates. You're still getting 5% in treasuries. So it's not like you're getting 0% sitting in cash. You can get 5% basically given to you, guaranteed. And in the meantime, you can be in these. So the barbell has now become, hey, fixed income strategy and growth. Meanwhile, the other kind of view is, if this is going to be a hard landing, why do I want to be in the cyclicals?
So here's the problem. And, you know, a lot of investors learned this the hard way last year. Some of whom who are on this program, who are not here today, but whatever. You can be directionally right and tactically wrong. You can call everything right, and you can be in the wrong stocks. And I'm wondering if we're setting up, once again, for that kind of market. At least in the early part of the year, it would appear as such. What do you think?
I mentioned it the first week, and everyone criticized me for mentioning it. You should have had, in the first several days of January, strong capital inflows to the laggard areas of the market. The areas of the market that underperformed in 2023 should have been rewarded with capital. You didn't see that. That's telling you something about what the market is gravitating towards. And the reason that the market wants to own these mega cap companies is because the revenue growth is there. It's visible. It's there. They could see it. It's not the hope, the dream that potentially revenue growth will accelerate in the broadening out of the market. We're just not witnessing that right now. Look, I've said financials to me, are the sleeper sector year to date. I've cited, a technical breakout in Citi. And looking at all of that and then saying, well, is there fundamentals to support what I'm suggesting? No, there's not. The fundamentals for the banks were lousy. Let's face it, earnings weren't good.